This is the Bringing Business to Retail podcast with today's guest, Ty Crandall.
Welcome to the Bringing Business to Retail podcast on SelenaKnight.com. Stay ahead of the competition by opening your doors to business experts so you can learn, grow, and be inspired. Passionate about bringing business strategies to independent retailers, please welcome your host, Selena Knight.
Hey there, and welcome to this week's episode of the Bringing Business to Retail podcast. I'm Selena Knight, your host, the retail strategist, and right now you're probably thinking, that recording doesn't sound as crisp and as clear as they normally do. Well, that's because I am currently recording this intro whilst I'm at the dog park. Yes, whilst I didn't record the interview with Ty Crandall at the dog park, I am recording this intro. And why is that? Well, it has been pretty hectic around our house this week. My husband's been away. We are in week 3 of Scale Your Store live launch. The stuff that's been coming out of the members in Scale Your Store has just been amazing. We've been diving into revelation, inspiration's been coming out. People have opened up about how their businesses are running, what's working, what's not, and so much progress has been made. And you know what? As the person who's guiding people through, this takes a lot of emotional energy. And so whilst right now I probably should be sitting in my office recording this intro, fact is, I just had to get out of the house. I have a lot of things that still need to be done before the end of the day, and I'm sure you can relate. Trying to jam everything into your day can be impossible. And I have a saying, which I use all the time, which is done is better than perfect. And this is just one of those cases where I know that Mooks is currently waiting for me to get this intro to him. I stuffed up last week. I recorded the wrong intro for the wrong person. So then I had to, at the last minute, re-record the intro. As a result, I'm currently behind. So my team are waiting for me to pick up the ball. And I know that I've got about 45 minutes before he's going to want this intro. So I had 2 options. One, on this cold, wet and windy day where I would much prefer to be sitting in my office with a cup of tea in front of my microphone, I could have sat down and recorded this intro. Or 2, the dog has to go for a walk. And whilst it is cold, I'm literally being rained on as we speak. I get to get out and get in the fresh air. I get to cross off 2 things on my to-do list. I get to record this intro and walk the dog. And as a bonus, I get away. There are the dogs. I get away from my office and out of that headspace, which is work, work, work. And as much as I'm being rained on and dogs are surrounding me right now, I am really enjoying recording this intro out at the dog park. I don't know that it's going to become a habit because I know that you guys really love good audio. So just for today, bear with me as I jump into today's episode. So a lot of the things that we've been talking about in Scale Your Store Live have revolved around money. You need money to grow your business. You need money to pay the wages. You need money to buy your stock. You have to hashtag be a moneymaker, because if your business is not making money, it is not a business. It's not a sustainable enterprise that is going to be able to keep going. So money has been a very big focus for us over the last couple of weeks, and really building a plan to make more money in our business, make more sales and be more profitable. Today's guest is Ty Crandall, and he is going to talk to you all about business credit. And I actually found this really enlightening because I've borrowed a lot of money in my life and I've paid back a lot of money in my life. I've had investments, I've had personal loans, I've borrowed to buy my car, I've borrowed to invest in my business. But I never understood this concept of business credit over personal credit. And so for me, it was eye-opening because even though Ty talks a lot about what's happening in the American market, I know that 75% of you listening are in America, so it's super relevant. But if you are anywhere else in the world, there's a pretty good chance that what he has to share is going to in some way apply to the kind of credit that your business can get in your own country. Now, of course, throughout this episode, Ty just gives his own advice. It's not financial advice. If you do want financial advice, please make sure to see the appropriate financial advisor, your bookkeeper, your accountant, whoever that person may be. But for now, let's explore the opportunities that your business could have if you had more money. This episode is brought to you by my customer lifetime value calculator. It is so important to know what it costs to acquire a customer, but it's super easy to get swayed by the acquisition cost, the cost per click, the cost per lead, the cost per sale. Your whole business could be revolutionized if you took into account what the customer is worth to you over their lifetime. And you know what? It's actually not that hard to work out. So if you would like to know how you could change out your whole marketing strategy just with this one simple little equation, head over to selenaknight.com/lifetime and grab my free customer lifetime value calculator and you can start using it straight away. Hey there, and welcome to this week's episode of the Bringing Business to Retail podcast. Now, you know, as a small business owner, that cash flow can be a roller coaster. Not just for you, for any business, whether you're big or small. And whether you're looking to grow or just to smooth out those peaks and troughs, hands up who's had those, me, having access to external funds actually gives you and your business a little bit of breathing space. But when you're a business, it can be a little bit tricky navigating the paperwork and the legalese that comes with getting your business access to those external funds. So with over 16 years of financial experience and a frequent contributor to radio and news shows, TV programs, magazines like Entrepreneur and Inc. and Forbes, as well as the host of his own popular podcast, Crandall, the business credit expert, is going to show you how you can navigate your way to business credit success. So welcome to the show, Ty.
Oh, thank you so much for having me. I'm so excited to be here.
I love your chipper voice. Do you say chipper in America? Is that a word?
Yeah. Hey, chipper. I love it. That sounds perfect.
It's really upbeat. Maybe it's just an Australian word.
I love it. I love all the Australian words like bloke and a chipper, and I love them all.
Good. It's bogan.
Oh, there you go. See that? I just learned a new one.
All right. Tell us a little bit about business credit. Like, what is the difference between business credit and personal credit?
Well, what most people don't know, I mean, most of us are familiar with consumer credit, and it's linked to our personal identifying number, and it's different in the country that we're based out of. But what a lot of people don't know around the world is that, your business has its own credit profile, its own score that's linked to your business identifying number. So here in the US, that's an EIN number. It's a little bit different, Canada and other countries, but it's exactly the same concept that, worldwide, businesses have their own identifying number within the country they are, and they could build a credit profile and score that's linked to that number, and then use that credit profile and score to make it easier to qualify for loans and credit lines. And they can use that credit profile and score to solely, and nothing else taken into account, qualify for all different types of revolving credit with Visa, MasterCard, even places like Staples and Amazon, they can obtain credit.
Yeah, here in Australia, and the majority of the listeners to the show are in America, so they'll be right on all these legal jargon words, these acronyms. But here in Australia, we have the choice of being a sole trader, which means you just trade as yourself. Very limited legal liability there. So if someone sues you, they can take your house, but it doesn't cost anything to start. And then we move into companies and partnerships and things like that. And those companies will have their own entity number, for want of a better word. So I know that, things like, for me, things like your Staples, we have Officeworks here in Australia, same. Those kinds of places tend to be a little bit more forgiving when it comes to getting credit. So are those the places that you should start with?
Well, I think there's a couple of different ways to go. I mean, when it comes to I look at this as two different aspects. There's business credit and then what I call financing, which are loans and credit lines. When it comes to business credit, I think any business should start building credit right away. They should go to, there's places like Uline and Quill, and there's these small vendor accounts that will give these net 30 type accounts that they'll give to almost anyone, and you can get them as a startup, and they don't do, personal credit pulls. Those are really good to start start building the business credit profile and score. And once that's established, then your Staples and your Amazon and your Walmart and all these other retailers open up. Then there's the financing side. And financing is really based on the strength that you actually have. So, for example, if the strength is that you have collateral, well, there's a lot of what are called asset-based lenders that will use that asset that you have as collateral to lend you money. Or maybe your strength is that you have consistent revenue and you want to start that way with a revenue lender. Or maybe your strength is just that you have good consumer credit and you want to use that strength to qualify. So business credit should be built right from the inception of a business. The other financing that's available, really the business owner wants to pay attention to what their strength is to determine the financing they're able to qualify for and where to start.
So you said they're assets. So obviously that's you own property or even the stock in your store or the inventory that you're holding. Is that classified as an asset?
Sure. I mean, so assets might be account receivables, other people that are, that owe you money, that are orders you fulfilled that have yet to been paid, purchase orders where you're trying to get, things that you need to fulfill orders. Maybe you have stocks and bonds, or here in the United States, you have a 401k. Those kind of securities can actually be used to qualify for business financing. As you mentioned, stock or what we call inventory can be used to qualify you for inventory financing. Or maybe you want to buy equipment, or maybe you already own equipment. You want to use that and borrow against the equipment. Real estate, commercial and residential real estate can be used. If insurance agents have assets in their recurring customers that are through a book of business. So vehicles, any of those type of things, the things that are really an actual asset, a lot of that could be pledged that for the lender to take if you default. Well, if the lender has something to take and get part of their money back, then it automatically lowers their risk considerably. And they don't look as much at factors like revenue and credit and these other things. And the rates are typically better too with some kind of secured financing using some kind of asset as collateral.
Because they have a surety, don't they? They know that if something happens, they can recoup some of their money.
Sure. And in a lot of cases, all of it. It's interesting because here in the United States, we have SBA, and SBA's underwriting guidelines require that a lender take every asset that the business has to be used as collateral and then carry over and start taking personal assets like the person's home as collateral. Because what they want is that if a person defaults, they're going to take every single asset to recoup as much of their loss as they possibly can. But then again, there's a lot of financing that's unsecured, which means there is no collateral being supplied. So you can imagine the difference in risk from a lender, that has some kind of collateral or something to hang their hat on in case of default versus one that doesn't.
And I can imagine those unsecured loans are significantly higher repayments, significantly higher interest rates.
You'd be surprised. I mean, you can still get pretty decent rates on unsecured financing, but absolutely without a doubt, you're going to get better interest rates when you're talking about providing some kind of asset as collateral. I mean, that's when you'll commonly see interest rates below 5%, which is lower than even, the big, larger conventional banks offer.
I have to say, the only benefit, and I use air quotes around the word benefit, to come out of the global financial crisis is these really low interest rates if you want to borrow money now. Not so great if you have money in the bank and you want to be making some money, but like you were saying, the interest rates now are still very, very affordable. Whereas I'm just trying to think, when I got my first home probably 20 years ago, they were up at 10, 12%. So now here in Australia, I'm talking about a home loan here, which is a little bit different, but here in Australia, we're looking at like 4%. So nearly a third.
And the same thing here. And a lot of that has to do with the shift in the economy that we've seen across the world over the last 10 years. What happens is that when we see what's happened, then our governments really cut, their interest rates or cut the interest rates that lenders are using to base their rates off of. And then when this happens, then we see home rates fall. We see interest rates, basically anything that's coming from a bank be much lower than what we're used to. So it's a great time. And what's interesting is that, a study just came out that actually talked about how since the collapse in 2006 and 7 in the economy, that big businesses had the lending into them has recovered just fine, but the lending to small businesses still has not even recovered to the level that we've seen 10, 12 years ago. So there's a lot of room to go in growth wise, and a lot of lenders are getting in the space and offering more creative ways for business owners to be able to obtain business financing.
Oh, that is so true. And this is probably not what you're going to be talking today, but I know with the retailers that I talk with, one of the very creative ways of getting credit is through PayPal. They have PayPal loans. So they take your average turnover that comes through your PayPal account from your e-commerce store, and they'll give you a percentage of that, and you just pay back out of the orders as they come through your store, and they do it rolling. It's fantastic, and the interest rate is really affordable. So this creativity, I think, it has been born of the global financial crisis. But I also know that really good retailers are having really good years. My clients have had some of the best years ever in the last 2 or 3 years. So business is getting better, but it's like the banks haven't quite caught up to the economy yet.
Sure. Well, look, the problem with banks, and it's easy to pick on big banks and say they're the bad guy, but what ultimately happens is they're government insured. So our governments insure them and require that they be very conservative in their risk. But anywhere around the world, when you start a business, what happens is that inherently is risky. The majority of businesses worldwide do fail because, business owners don't necessarily know what they're doing when they're getting started in a lot of cases, and a lot of them don't have access to the money they need to grow. So business lending inherently is very risky, and it's really a bad place to go to the big banks because they're just not the ones most equipped to deal with risky scenarios. They're not allowed to lend in those scenarios. So what happened here in the United States, for example, is that, of course, when something like this happens, a lot of bureaucrats get involved and they come out with all kinds of regulation to try to, make it look like they're trying to solve the problem, usually, unfortunately, regulating the wrong things to begin with. So they've now tightened it and made it harder for banks than ever to lend money. The good thing, as you stated, is that what's happened then is it's opened up this entire sector of alternative lending where all these other lenders are coming into play, like PayPal, for example, where these lenders have said, wait a second, all these banks are pulling back. There's a huge opportunity now for us. Let's start looking at a strength that the business has and lending money based on that strength versus, the banks that look at the entire business and owner as a whole. So PayPal, for example, just looks at your revenue. If you have consistent revenue, if you're managing your bank account, your PayPal account responsibly, they'll use that one factor to basically lend you money. As we talked about before, other lenders will look at only the fact that you have collateral to lend you money. There are other lenders that will just look at the fact that you have good consumer credit to lend you money. So what's happened is we've seen this huge shift. And here in the United States, for example, over 98% of business financing comes from these alternative lenders. Literally less than 2% of financing is even coming from the big banks to small business. So it's just absolutely taken over. It's become easier than ever to get money. And there's a lot of different types of sources of capital that's out there, like PayPal or like Square, that do these really fast, easy to obtain advances just based on the fact that you have consistent revenue.
And it just pays to be knowledgeable about these kinds of things because, like you said, that is a whopping statistic. 98% of business finance isn't coming from the banks. And I know personally how difficult banks can be. My husband and I have property in our own names, property in joint name. We have a company, we have a trust, we have partnership. And so going to the banks to get a mortgage, we have a broker. He loves us, but he also hates us. And every few years we rock up and he goes, okay, let me just clear my schedule for the next 2 weeks. Because we the banks have their checklist. And if you fall outside of those checklists, you automatically get a no. So he has to literally find he has his own personal lending business manager, and he'll be like, no, we have to sit down and talk first, and then you can have the paperwork. You want these people. And so before we had that broker, we just kept getting rejected. We were just in the too hard basket. Nobody wanted to actually look at the assets that we had. And of course, once somebody can make sense of all of your entities and everything, they're like, oh yes, we'll have you. What would you like? So using someone who has the knowledge like yourself can get you access to information and to funds that you didn't even know existed, right?
Absolutely. I mean, when we look at our company, our chief operations officer, she was the biggest business banker for Wells Fargo Bank. And the reason she got out of it and got into our space was because she became so frustrated that people could change very simple things and get approved, but the bank was not allowed to tell the actual the business owner that, the customer that. And, in our world, that is ridiculous. We believe in a philosophy where education is very important. You educate people. Look, here's what lenders are looking for. If you meet this criteria, you get approved. And if you don't, you don't. And what's crazy is that people get denied because the name on their application doesn't match exactly with what the state has or what they're registered for, their entity is registered under. I mean, exactly. So you can imagine coming in with this huge stack of paperwork that you spent a month gathering and not even knowing this, but your loan got denied because your business name didn't match exactly with what here we have the Secretary of State records. It's crazy. But that's the problem is that, lenders, even the front end bankers you talk to, they're not the underwriters. They don't even know. So when you talk to front end bankers about corporate credit or business credit, they don't even know this. They don't understand it. You have to go one layer deeper to their underwriters, and their underwriters understand. So even when you think you're meeting with your front end banker, they may be trying to help you, but there's information they're not permitted to give you, and there's a lot of information they don't even know or understand because they're not the ones underwriting these loans. Then when you're working with people that understand the underwriting process, that understand the automated approval, that here is the 20-point checklist that every lender's looking at, let's make sure you meet these criteria before you apply. Like you said, it's like a light switch goes on, and all of a sudden a denial on the exact same file becomes an approval just because of the understanding of what they're looking for, the matching of the business to make sure it meets that criteria, and the structuring of a package or a deal where it makes sense for the lender. And that's why I think brokers make a ton of sense, whether you're buying a home, whether you're getting business financing, personal financing, somebody that specializes in any space like that, you're going to have a greater advantage because they understand the game per se. And if you don't, your chances of winning are very much nil. And that's why, over 90% of applications to big banks end up getting denied.
And to be honest, the broker isn't going to fleece you. The broker gets paid from the bank. They don't get paid. You don't have to pay them. So they get their commission from the bank, and it's in their best interest. They put all this hard work in. I love brokers. I have brokers for everything. Broker for mortgages, brokers for insurance, because like you said, they know everything inside out, but it's also in their best interest. They're not going to take the time to put your application together if they don't think that you're going to be able to get the loan, because then they get paid. If you don't get it, they don't get paid.
Well, I agree. And all brokers are different. So I used to be on the consumer financing side, and we could charge points on the front end. We could charge points to the customer on the back end, and then the lender would pay as well. In the commercial space we have the same ability, although, we don't charge anybody points. We just get paid from the lender. And what's interesting about these scenarios is that we also get volume discounts. You may go to a lender like On Deck, and you're one person. For On Deck, we are millions of dollars of fundings every month. So it's not uncommon for somebody to come into us and get denied, and we go to a bank like On Deck and they say, wait, I've already been there. And we say, I know. And we are able to get them approved because we have so much pull than an actual one person going in does. Or we get better pricing and better rates at a discount that we can then pass on directly to the customer because, again, we're doing volume. So in a case like our world or the world you're describing where you're not even paying anything for the service, as a matter of fact, it's not only free, but it's better than free because you're actually getting a discount because you're dealing with somebody that has pull with those lenders. It makes a bunch of sense. Plus, in the world of lending, which lenders are hot and which ones aren't, and it's very interesting, the consumer and commercial space. Whereas a bank like On Deck or Funding Circle, which is, which is lending in the UK and Australia and the United States, all across the world, one month On Deck will be on it. They will be, it's like they'll accept and approve any deal you send them. And the next month, it's like they've closed their doors completely and are scrutinizing deals at a level that you've never seen. Well, people that are in the world know which lenders are hot, know which ones aren't, know which ones want. It's like the funds that they're accessing just became available again for the month, and they're trying to fill it versus the ones that aren't. And so it's just a huge advantage pretty much in anything you do, right? To work with an expert, because the experts have that inside knowledge you don't. And in this world, it determines whether you'll get approved and denied, and also determines the rates and terms you'll pay.
Okay, so I've been mixing, you've been staying on track. I've been mixing personal credit and business credit in this conversation. So is it actually possible for your business to get its own credit funding externally of you? We've talked about, yes, it can get credit, and you did talk about SPA earlier, potentially wanting to take your house, but are you able to get credit, to get finance where you are completely excluded if anything goes wrong?
Absolutely. It's the way the system was designed to be. And what's interesting about the system is that corporate credit is what's recommended by almost every agency that's out there. So here in the US, we look at SBA, we look at NASDAQ, and Forbes and Fortune and Inc. magazine. They all recommend business credit for the same thing. You need to separate your personal and business liability. You need to separate your commercial and your consumer credit. The problem is that the commercial credit reporting agencies and the credit issuers that lend based on corporate credit have done a very good job of just keeping this hush-hush. They don't talk about this often because they don't want the small guys to even know about it. They want companies to grow to a point that they get CFOs and they get financially savvy people in their organizations that know these things, and then they will gladly give those companies credit because those companies are then big enough and easily can qualify. But what a lot of people don't know is even startups can follow the same system that the big companies follow to get the credit. It's just a matter of knowing the steps and knowing the process. If you know the steps and process, then even the smallest startup can still be able to come in and obtain corporate credit, establish a corporate credit profile, establish a corporate credit score, and then use that business credit profile and score to qualify for all different types of credit. Now, it would be a long, long, long time and a lot of established credit for it alone to help you qualify for loans. Having corporate credit established will make it easier to qualify for loans and get you better terms. But to be used solely for financing, it's mostly solely used for revolving credit. It's the Visa cards, it's the MasterCards, it's the American Express cards for $20,000, $40,000, $50,000 or higher that you can get. It's the $30,000 that you can get at Apple, and the $50,000 you can get at Walmart, and the $20,000 that you can get at Best Buy. It's available at almost all major retailers. You can get vehicles financed with it. You can get the cash credit, which is the Visa card, the MasterCard. You can get fuel cards. All of that you can get based on corporate credit alone and nothing else. But when it comes to loans, they're still going to look at other factors. Corporate credit being established just makes it easier to actually be able to get approved.
Okay, so it's very important to think about credit being kind of two different things. One is this revolving kind of line of credit through stores or through cards, and the other one is a big chunk of cash to buy something.
Right.
Okay,
right.
So now that we've decided we're going to go and set our business up to get probably the revolving credit in some way, shape or form, what are some tips that you can give us to make sure that the business maintains a really good credit profile and a really good, healthy credit score going forward?
Pay your bills. Next question. No, I'm just kidding. It really is that way, though. I mean, in the corporate credit world, the score is almost solely based on payment history. So when we look at Equifax and when we look at Dun & Bradstreet, their scores are only based on credit history or payment history. And Experian, 85% of the score is based on payment history. So it really comes down to how you pay your bills. As long as you get credit that reports to the reporting agencies and you pay the bills as agreed or on time or early, that's what will get you good scores. So to get good scores, it's easy. You get credit that report, you pay it as agreed. And to maintain the scores, it's easy. You just have to make sure that you continue to obtain more credit. The more credit you obtain, the higher the limits you get. Same as consumer and commercial credit with that. And then you also want to make sure you pay your bills on time. If you do that one thing and that one thing only will give you well-established commercial credit scores.
And let's be serious here for a moment. If you are going out and getting this credit, you have to be able to pay for it. You can't just go and get your $50,000 Visa card and then go on a shopping spree.
Right.
Remember that the bill comes at the end of the month. So be very responsible when it comes to choosing your credit limit, because quite often you get to choose.
Well, absolutely. And that goes with anything, right? So you want to make sure that you're only getting credit that you could pay. And this is one of the reasons that, a lot of lenders don't like to lend to startups, because they're just figuring out what they're doing, and they're usually not as fiscally or financially responsible as somebody that's got an already established business, that's already used to budgeting money, etc. So you never want to get more than you can use, because if you default, then some things can carry over to your consumer credit as collections, or they can come after a lot of your business assets. And depending on the country and depending on the entity you've chosen, sometimes just because the entity you've chosen, the business type that you've chosen, will also make you personally liable. So, with anything, you want to make sure you're paying the bills as agreed, because if not, there's always repercussions. And the repercussions are that they can come after the business or possibly even your personal assets.
Okay, that was actually going to be my next question, so thank you for answering it before I even asked it. I have another question about credit cards. I am not a financial advisor. I will just talk about my situation. I love a credit card, mainly because I get a crap ton of frequent flyer points. I'm flying to America in a couple of weeks, business class, and I think I paid $20 in taxes for it. All my points go to flights. and this is how you afford to fly business, people. You never pay cash for it. You always use points. So do you suggest that when somebody goes to get a credit card, they look at the benefits that comes with it? Because I have to admit, when I just moved my credit card to Amex, because here in Australia, the government regulated how many frequent flyer points you could get from the banks. And of course, Amex is not a bank here in Australia, so they kept giving us our 2 points for every dollar, whereas the banks went down to half a point for every dollar. So that's a quarter of what we could have, the points that we could have amassed. And my husband is the same. He puts everything through his credit card, and then we just pay it off. So you end up with literally 500,000 points. It doesn't take that many points to fly to America from Australia. I think it was 200,000 points return for business class. And if you're putting that much through, it's like money in the bank. It's like flights in the bank. So do you suggest that people look at the perks that come with a credit card? Or is that just me?
Absolutely. I think everybody's a little different. Some people do it for 0%. Some do it for rate and APR. Some do it for points. I'm the same as you, right? The most common cards that I use in the personal and business are my Marriott and my American Airlines, for obvious reasons, right? Because what I ultimately do is I get the ability to fly for free. I get the ability to do hotels for free. So it works really well. On the personal side, my wife and I put every bill that we're allowed to put on our credit cards. And then when we get paid, we just use the pay to actually pay off the credit cards. And for the same reason you're discussing, because this gives us this accrual of points. And then, that pays for at least 1 or 2 vacations completely paid for in a year. The same thing for the business. The business can then help our travel expenses just because we're doing it. So my advice with credit cards is that, you should look at the ones that you're going to use the most. Like, for example, we got Marriott because we just end up staying at more Marriott properties than any other property. So now we do that, and Marriott loves it because now we seek out their hotels wherever we go to get their points. We chose American Airlines because it just so happens that it seems like most of the flights we book are American Airlines flights. So we went ahead and got the American Airlines credit card. We got 30,000 plus points, 75,000 with some different counts like Marriott, etc. And then we continue to accrue money every time we spend. So we put things like our advertising, completely on our credit card. And then every week we pay it off. We might spend $10,000 in advertising for the business. We put it all on an Amex, and then we pay the Amex off. And what else is nice about that is that's the key to getting higher limits. So we just asked Amex for a $20,000 increase to our limit. They gave it to us immediately. We asked Capital One for a $5,000 limit increase. They wouldn't because we don't use the card. Well, we don't use the card because they report to the Consumer Reporting Agency. So it's like, we're not going to use your card as long as you do that. So again, the more you use the card, the higher and faster your limit climbs up as well. So it's also a good idea every 6 months to call that credit issuer and ask for a limit increase as well.
As long as you can afford to repay it.
Absolutely. I mean, and that's what it is. In the business world, typically we're not keeping a lot of money on credit cards. Some businesses are. In our world, we don't carry any debt. I mean, we'll put $50,000 on credit cards in a month or more, 50, 100,000. But we pay it off weekly, so we never actually end up carrying the debt. We're just using them for points, and we're also using it because our bank freaked out when we were trying to use our debit card for all this. So, there's so much fraud nowadays that, banks don't want you doing that. They're like, no.
Cash?
You can't.
What do you mean cash?
Yeah, so we can't even do it anymore. Our bankers don't want us using our debit card. So you're almost forced into a position for even security reasons to use credit cards versus actually use debit cards. And it is safer because I don't know about you, but I've definitely had them skim my credit card somehow, and then all of a sudden I have crazy transactions and my bank's calling me and it's a mess.
Yes. I do remember the call I got one day from the bank, which was, we're just checking if you're in Peru right now.
Right.
No.
Right. Well, my wife and I had that happen. It was funny because it was like Dollar General was a charge, right? And it's not a place we would ever shop. And so we thought, we're like, well, they just know our style. They just know that like we don't shop at Dollar General. But the reality is they knew that we couldn't have just used the card down here and also been in Michigan, which is a whole state across the country at the same time. So they have algorithms that automatically are looking for certain things and then notifying it. So the bottom line is it's in everybody's best interest, the business owner, the bank, the credit issuer, to use credit. But like you said, you have to be wise. It's not a matter of accruing a bunch of debt. It's about just paying on a credit card, which you would normally just spend cash or out of your bank account to do. And then you have to have that money still in your account to be able to pay off that debt when it comes time to pay that bill.
Yeah, I ran into the same problem that you did. We had a $5,000 daily withdrawal limit. And, sometimes you're paying your Facebook ads bill. It's more than $5,000.
Right.
So you had to go. I mean, I would go to credit card anyway. But I remember right back in the day, that is what tweaked me to go, I need a credit card for this because the bank won't actually let them take that much money out in one go.
Right. Yeah, you're exactly right. And that's the same thing is that, look, I've gotten into trouble with consumer credit cards. So I stayed away from them for a long time. And the problem with that is that then I lost all the benefit of all these points you accrue, for one. And for two, it quickly became problematic when they started to take money out of our account or spend money on the account. So we just learned that, look, credit cards are just a safer way to go. And then you get that secondary benefit of accruing points at the same time.
Very, very wise. Okay, you've given us lots of information, lots of food for thought. What is the one tip, if people could walk away from this podcast and you feel like you've left them with one nugget that will change their concept or their ability to get business credit, what is it?
Get your debit card, because you could get $5,000 out in cash a day.
Oh, we were just talking about debit cards.
No, look, you need to get money before you need it. And that's the thing. That's the biggest mistake that we see business owners make, is that what happens is they wait until they really need money to get it. And then the problem is they've already put a bunch of money on their personal credit. They've already lowered their consumer credit scores. And banks are looking at this. Banks want to lend to people that are financially safe. And so when you're going out and building corporate credit and getting loans and credit lines, lines, especially credit lines. When you're securing these, when you're in a good position and you don't need money, and somebody pulls your credit and they see that you don't have all your credit cards maxed out, you have a significantly better chance of getting approved. And it also helps you too, because when you're building business credit, this isn't immediate. This is a process. So you don't want to need money and then need to go through a 3 to 6 month process to get it. So start building your business credit the minute you start your business, and make sure that you go in any opportunity to build business credit, get business credit, access credit lines, to access money to have at the ready when you need it. Take advantage of that opportunity. Most businesses fail because they don't have access to capital when they need it. Unexpected things come up and they can't carry themselves. They don't have the finances that the financial access they need to carry themselves through those tough times. It's the biggest mistake that I see business owners make. It's the biggest mistake that I see push business owners out of business, and it's so easy to fix. Just start building business credit the minute you start your business. Access credit lines whenever they're available to you, just to have them ready, and that way you have money when you need money, which can help you through some of the toughest of times.
Fantastic. Now, speaking of money, tell me, what is your favorite store?
Oh, I'm an Amazon guy.
Everybody loves Amazon.
No, it's so convenient. I'll tell you a funny story is I walked into Best Buy the other day and bought a computer, and I walked down, I told my wife, I said, that was like an amazing experience. Like, I haven't walked into a physical store and like looked around, and it was cool. They had like light bulbs that turn on automatically with your phone. I feel like I hadn't been in a store since the 70s with all the new tech they had out. So it's because Amazon changed it. They just made it super convenient. So I buy a lot of my stuff on Amazon because I'm conscious about building business credit. I spread things out to other stores, but I have to consciously stop myself from going the Amazon route to go there, because it's so convenient. Everything you need in one place, and they have such a simple checkout process that for business owners where seconds or minutes mean so much to me, it's just a greater way to do it.
There you go. So what we need to take away as independent business owners is make it really easy for people to buy. Don't have the convoluted checkout process. Make things easy to find and make buying really simple.
Absolutely. I think that's it. And I think we're in a world now as well. Something to think about is that, the biggest companies that are just becoming billion, if not trillion-dollar businesses, they're using other people's assets and other people's resources, and that's another thing to keep in mind too, is business. I mean, that is the future. It's the Ubers using other people's vehicles instead of stocking their own. It's the ways that you can actually get directions because they tie into other people's cell phones to get traffic data. It's everything. It's Airbnb, where you can stay in other people's homes. I think that's really the wave. That's the future of what we're seeing. These biggest companies are pulling together assets and information that are not theirs and putting it in one place and making it convenient for people to access. And I think that's the biggest shift we're seeing right now in business.
Definitely. Now, I've had a look at your website, and you've got quite a lot of information on there in the form of blogs all about business credit. So if people would like to read a little bit more, or maybe even chat to you about your services in terms of organising business credit, where can they find you?
They can go right to our website, creditsuite.com, and we've got a great free guide that maps out the steps of building business credit. Works just as well in Australia or the UK as it does here in the United States. And that's at business credit, or that's creditsuite.com/EIN. So that's creditsuite.com/EIN, the letters EIN. And if they go there, they can even grab a free guide on building business credit.
Fantastic. Thank you so much. And of course, we'll pop a link to the website and to that guide. Sounds like it's going to come in very handy for a lot of people into the show notes. Thanks again so much for sharing all of your knowledge here on the show today.
Thanks for having me. I had a blast. You're such a gracious host.
I hope you enjoyed this week's episode of the Bringing Business to Retail podcast. You can find all of the show notes over at selenaknight.com. If you found something that you heard today particularly useful, I'd love it if you could leave me a review on iTunes or Stitcher. And of course, feel free to share this episode with someone that you think could benefit by listening to it. Want more retail biz strategies? You can watch the Bringing Business to Retail TV show, where each week I'll answer a question or provide you with a simple, actionable retail biz strategy that you can implement in your business right away. If you have a question or a guest, I'd love to hear from you. drop my team an email at podcast@selenaknight.com, and I'll see you on the next episode. Have a great week.